Well, if you stopped watching David's video after about 5 minutes last night, you might be surprised to see me here. No, we are not quitting these videos. That was an April's Fool's joke, and a very good one at that. I told him, the next time you plan on doing something like that, let me know. I'll go buy a whole bunch of ambulance stocks or hospital stocks or something along those lines. So anyway, great to be at service here for you yet again on the Market Outlook video. Today was a mixed day in the markets. We did have some of the indices up, some of the indices down. The big news story was, of course, Trump threatening to shut down the southern border. But generally speaking, markets have been humming right along. We do have the S&P 500 and the NASDAQ hitting 5-month highs as of today. So we're going to talk about one of the leading sectors, and then we're going to take a trade based off of a stock in one of those leading sectors in our trade application example. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's April 2nd, 2019. First of all, if you're new, welcome aboard. Remember, you can go to our YouTube channel, click subscribe while you're over there. Also sign up for our email distribution list that you'll find in our description area. You can also follow us on Twitter. My handle is @BrandonVanZee. We would encourage you to click like and retweet if you enjoy these videos. As David mentioned yesterday, that engagement really helps us along with our business. So we know we ask you to do that quite a bit. You guys usually follow through for us, and we do appreciate that. We also have a presence on Facebook. Feel free to join our group over there at the web address embedded in the logo in front of you. All right, let's go ahead and dive into the charts here to see what is taking place in the US stock market. As you can see, I've got chart 4B pulled up here in front of us. These are the four major U.S. equity indices, where we've got the S&P 500 in the upper left, the Dow Jones in the upper right, the NASDAQ Composite in the lower left, and the Russell 2000 in the lower right. Now you'll notice here what I mentioned in the intro, the high label here on the chart itself is hovering right above today's candle on the S&P 500, and also above today's candle on the NASDAQ. And that tells us that we are at 3-month highs. Remember, each one of these charts is 3 months in length. But if you were to go back and change this to, let's say, a 6-month chart, you'll notice that where we stand today on the S&P 500 takes us all the way back to right back here early October. So not quite a 6-month high that we're putting in here, but definitely a 5-month high, and we're not all that far away from a 6-month high. So this has been a tremendous rally that we've seen thus far in 2019. Same thing can be said for the NASDAQ. In fact, the NASDAQ's probably been even a bit stronger than the S&P 500 itself because of some of those key areas like technology doing as well as they have. One thing I did want to point out here regarding the Dow Jones, that's our chart in the upper right here. The Dow Jones actually has what's known as a bullish intermediate confirmation signal today. Remember, that consists of two things. First of all, what you're looking for is asking yourself, is the green line, in this case it's called the intermediate line, bullish right now? And the answer is yes. Remember, when the green line is trending up between our reversal zones at 80 and 20, we consider that to be bullish. So that's the first piece of the puzzle. Remember, you can also have that green line in the upper reversal zone. Anytime it's above 80, we consider it bullish, whether it's rising or falling. But if it's below 80, like it is right now, it's at 70.19 and rising, we do consider that bullish. So that's the first check mark you want to make. The second check mark would require the red momentum line to be in the lower reversal zone at the end of the candle, which is where we stand here today. Notice that that momentum line is currently sitting at 15.26 and falling. And so that does create that bullish intermediate confirmation signal. Now, before we get overly excited about that, keep in mind that while the blue near-term line is not technically part of that trade signal or that setup, what we have noticed over the years is typically when you see that blue near-term line sitting between 50 and 20, the bullish intermediate confirmation signals are typically a little bit more convincing. They're a little bit better going forward. So we wouldn't call this an ideal bullish intermediate confirmation signal, but it is one nonetheless. And you will notice that just yesterday, the Dow Jones did hit a new multi-month high as well. It pulled back a little bit today, likely a result of Walgreens, some of you that follow my 9 at 9 in the morning, where I put that post together on Twitter that shows you which stocks are up and down the most at 9 a.m. Eastern time before the market opens. Walgreens was leading the way lower of all those stocks that I track, and so it makes sense that when you have an outsized move in one of the 30 stocks that makes up the Dow Jones Industrial Average, it can have an outsized impact. So that was part of the reason that it was not able to put in an intraday high here today, the same way that the S&P 500 and the NASDAQ were able to. Now note that at the end of the day, the S&P 500 was basically flat as a board. So despite putting in kind of a new intraday high here, we were actually just finishing flat, 0.00%. NASDAQ did quite a bit better. It was up 0.25%, so a little bit more of a legitimate move there out of the NASDAQ here today. Notice down below here in the lower right that the Russell 2000 is the one that has caused the most heartburn, the most aggravation for traders, at least if you want to be bullish. Where we stand right now with the Russell 2000 is it was down today 0.18%. But it's really the flatness of the move here recently that is concerning, whereas we have more of an upward tilt on these other indices here. So it does seem like the small caps remain the laggards. However, I will point out that according to the market forecast intermediate term line, the Russell 2000 does have a bullish posture, just like we do have with the S&P 500, the Dow Jones, and the NASDAQ composite. But the difference is the Russell 2000 is what is known as a weakly bullish posture, not a strongly bullish posture, a weakly bullish one. And remember, you can gauge that by looking at the different colors on the chart itself. Notice that the colors up here are a darker shade of green on these other three charts. This one has a lighter shade of green, and that will result when we have a green line that is starting to rise but hasn't yet passed the 50th percentile area of the graph. So you'll notice right here the intermediate line is at 43.23 and rising right now. So since that has not crossed 50% yet, we would consider that weakly bullish. So at this point, it looks more sideways to me than anything, whereas we do have more legitimate upward trends out of something like the NASDAQ composite. So as it stands right now, bullish postures across the board, and we have the Dow Jones that's putting in the bullish intermediate confirmation signal here today. Let's go ahead and take a look at our next chart setup now. This will be chart 4C, and this is our 3 green arrows chart setup. We have maybe a little bit of positive news here to report in that most of these charts do have 3 green arrows right now. I say most because it's not all. As of this exact moment in time, we did get the Russell 2000 to put in a red arrow on the moving average itself. So the Russell 2000 has 2 green arrows, 1 red arrow. The other 3 charts, the Dow Jones, the S&P 500, and the NASDAQ composite all have 3 green arrows. And remember, on this particular chart setup, which is chart 4C, for those of you that are premium market scholars that are following along at home, remember you can look at the color background of the chart itself. You can see that green background there, and right there, to remind us that we do have better than average conditions for trend trading as it stands right now. Of course, I teach a trend trading class here at Market Scholars every Monday. It's called top-down trend trading, so we try to blend the idea of buying stocks with higher highs and higher lows with the idea of top-down analysis, where we're looking for strength amongst sectors that's out there. In fact, maybe I'll take a quick moment to step away over to the internet to kind of show you where we stand with the sectors. Remember, we use the sector selector in my class itself, and that particular sector selector does consist of a couple of different graphics. The top one I typically share with the public. The bottom part of the graphic there is usually only reserved for my students in my class, but nonetheless, this can give us a good sense of what's been going on with sectors here recently. And I did want to point out that technology for the 3rd straight week remains the #1 sector according to this ranking system that I use here. Of note, we have a new cellar dweller. Those of you that have been watching this for a while will know that energy had been the worst performing sector for probably going on about 6 months worth of time. This graphic only goes back 3 months because I've got to kind of reduce it just to make sure it's digestible for your eyes. But you'll notice that energy is now up there to the 9th ranking. It had been right down here with these kind of brown circular pegs here down in the bottom line, and then started to make a move off of the bottom the week before last week, and then last week it got up to number 9. Well, that means if energy's not at the bottom, who is? Well, that's the financials. Of course, a big reason behind that is what's been going on with interest rates. Interest rates have largely been falling on a year-to-date basis, although they've caught a little bit of a rebound here recently. So a little bit of a shakeup at the bottom end of the sector selector. Top end remains largely the same, where we have technology strong, along with a few of those more interest rate sensitive areas continuing to hold up reasonably well there as well. And quick reminder, I'm just seeing this over here in our popular recent posts. Looks like my trading plans are showing up over there. So remember, for those of you that are premium members of Market Scholars, feel free to check out the trading plans for my various trading rooms that I teach here at Market Scholars. Also, while I'm over here, quick reminder that if you get value out of these free videos here, those of you that had a mini heart attack yesterday when David told you he was going to stop producing these videos, remember, we ask one thing of you, and that is simply to click like. We don't think it's too much to ask out of you. And remember, when you're watching a 30-minute show on TV, you got to watch all this advertising and all this other stuff. We don't do that to you. We give you 30 full minutes of action-packed information here on a daily basis. And so in return, what we ask out of you is simply to click like. If you have a Twitter account, you can click like directly below where you're watching it on our website. Otherwise, we usually pin our Market Outlook tweet to the top of our timeline on Twitter. If you're on Facebook instead, we have a way for you to click like here by clicking that thumbs up right there. And you can also click like directly on our website right there. Again, that really helps us along as small business owners as we try to reach a wider audience. Also, quick reminder that we had some excellent classes today. I taught my dividend growth investing class where we concentrated on consumer staples stocks. David taught his directional option strategies class. Tomorrow, he's got his options inventory trading class at 11 a.m. Eastern Time, and I've got my Strategy Lab swing trading class at 2 p.m. Eastern Time. So looking forward to some excellent discussions for those of you that are premium members of Market Scholars. All right, let's go ahead and get back on track here now with some more analysis. Let's move on to our 1040 crossover method chart, which is chart 4D. Now, as this pulls up here, a reminder of where things have been here recently. We've had positive crossovers on 3 out of the 4 indices, and that remains the case right now, although the Russell 2000 is getting awfully close. We've been kind of watching this for the last 4 weeks or so. Remember, this particular chart setup, which for those of you that are premium members, chart 4D, you can follow along at home. These are 3-year weekly candle charts that we're dealing with here. So it's a little bit further back in time to give us a kind of a broader view of what's happened with the markets over the years as opposed to just the last couple of months. And what we're looking for here are crosses of the moving averages themselves. And you can see on these charts, we've got it color coordinated where the orange line represents the 10-week moving average and the blue line represents the 40-week moving average. And you'll notice over here with the Russell 2000, it's the only one that still has that pink background. In other words, we haven't had enough of a move higher to push that more sensitive 10-period moving average up and through the less sensitive 40-period moving average. Remember, you can eyeball that down below here as well. When that black line on the MACD2 lines is below the pink horizontal line there at 0, it means that that crossover has not occurred yet. So you can see here, like on the Dow Jones, the S&P 500, and the NASDAQ, all of those crosses took place earlier in the year. So really, we're still waiting on that one laggard. It seems to be a theme that the Russell 2000 continues to be the laggard of this market. So we'll see if it can eventually get there. It's getting awfully close, so it might be just another couple of weeks before it can get there, assuming there's not some sort of major pullback in the market along the way. Let's now take a look at our intermarket analysis, and this is our 12-grid analysis here. Remember, when we're looking at the background colors of these charts, they represent whether the posture is bullish or bearish according to the intermediate term line on the market forecast technical indicator that you can find over at Thinkorswim and TD Ameritrade. And so this is chart 4E, and this is where we're looking at things that aren't necessarily hooked to the stock market directly. So these will be things like commodities and interest rates, etc. So as we look at these various charts here, you'll notice the VIX remains trading near multi-month lows, so there's not a whole lot of fear in this marketplace right now. You'll also notice that Treasury yields remain in a downward move. However, Treasury yields are actually up over the last week. And that does, shake things up a little bit there, because it got pretty ugly from basically the beginning of March to the end of March. That was a one-way ride right to the downside there for yields and interest rates. Well, we have had a bit of a reversion to the mean here over the last week, but remember, that is not necessarily a trend change. In fact, from my perspective, it is not a trend change. Right now, my assumption is that interest rates will continue to go lower, at least in the foreseeable future. Obviously, I reserve the right to change my opinion when I start seeing different changes on the charts, but right now the assumption is that moving average continues to go lower, and no chart goes straight down. You have these mini pop backs, and then you kind of fall back into your trend. So that's where my expectations are at this current juncture. Of course, the opposite of that is the chart directly below it, which is your U.S. government bonds. Remember, bond prices and yields move inversely to one another. So just like yields popped higher over the last week, bond prices have fallen lower over the last week. But same story. Bonds remain in an uptrend, and that is my assumption going forward until I see otherwise. Other things to be aware of here is that we do have what's known as an overbought cluster on REITs. Remember, when we were looking at the sector selector a moment ago, real estate was in the top 3. In fact, I think it was ranked 2nd. So real estate stocks have done very well. Talked about them in my class yesterday. And at some point, they might get a little bit too hot. And that's what those overbought clusters are designed to kind of try to point out for us. Remember, when you're looking at these 12 grids, for those of you that are premium members that have it loaded into your system, you can just right-click on one of the charts like I'm doing right here, and then go to maximize sell, and then down below you will actually see the market forecast indicator pop up for you. There's just not enough room when I'm showing you from a 12 grid view to be able to see that, but just to confirm, when you see that red dot up there, it's basically telling you down below that we have an overbought cluster signal where we've got the green, the red, and the blue line in the upper reversal zone all at the same time. So it's basically saying that this stock may have gone up a little bit too far, too fast. Also keep in mind that the market sentiment line, we don't talk about that quite as much because it's really for longer term investors, but notice that the market sentiment line is also in the upper reversal zone. So maybe even add additional emphasis to that overbought cluster. Other things to be aware of: US dollar has been strong over the last week, but we are currently at a little bit of a resistance area. Notice that on our most recent pullback on the US dollar, we pulled all the way back down on 320 to exactly where we were trading on 226. Now that we've responded to that, we were able to save that possibility of going into lower lows and lower highs. It basically bounced exactly where it needed to. Well, notice where it went back to on the chart. Now we're suffering the opposite consequence, which is we have a security here that is trading exactly at the same place of where it was trading on March 7th. So we have almost equal lows and we have almost equal highs in the most recent move. So we're kind of waiting right here to see whether the US dollar wants to break out officially above this prior resistance area. And if that is the case, then we'll be willing to kind of go on record saying, yeah, our uptrend is definitely intact right now. Right now we have a hunch that it is, but that's the way that the chart would be able to prove it to us. And remember, the US dollar does have reverberations across the various stocks that you might be trading as well. When the US dollar is strong, we typically find that foreign stocks are weak on a relative basis, and we also often find that commodities will be weak on a relative basis. You will notice that as the US dollar has gotten stronger here in the last week, gold and ag commodities have gotten weaker. Both of those are bearish charts as it stands right now. But crude oil remains a little bit of a conundrum. That thing just keeps humming right along as though it doesn't really care what the rest of the world of commodities is doing. Crude oil has been a really pleasant surprise, and that probably goes a long ways to explaining why energy is no longer dead last in the sector selector. So we're starting to see some legitimate movement out of the energy patch there. Let's go ahead and take a look now at chart 4F, and this is our foreign stock markets 12 grid. And as we look at this, you will notice that the only pink chart we have on the board from an intermediate perspective, we have a bearish posture on Russia, but otherwise from an intermediate perspective, we have bullish postures across the board on the rest of the chart. So that's somewhat promising. It kind of gives you a sense of risk appetite, and it also reminds you that while the US dollar can be an important influence on various securities out there, it doesn't have to mean anything from an absolute basis. Note what I mentioned a moment ago, which is that when the US dollar is strong, you oftentimes find that commodities and foreign stocks will do poorly on a relative basis, not necessarily on an absolute basis. So you have to keep that in the back of your mind as well. But this is a good, pleasant surprise that we're seeing here where foreign markets are largely holding in there. As I look at these various charts, I don't really see any that are just horrific, right? We see that Brazil, which is the chart in the upper left here, doesn't look all that great. Yes, it's true. It does have a bullish posture according to the market forecast, but the price action does lead you to believe that there may be some hiccups in front of it, because we do have a moving average that's painted red there, so it reminds us that price is currently below a falling moving average, and you do have a little bit of a hanging man type of a candle formation here as of today as well. So beware a little bit more there on Brazil. I'm not sure if I'm sold in my own head that thing is going to continue to go up, but there are some better looking charts out there. India continues to be very robust to the upside. China doesn't look half bad. It kind of slowed its ascent there a little bit, but nonetheless remains above that rising moving average. Canada looks okay. Australia, nice pop higher yesterday, by the way, on Australia. It did break out above that prior resistance area, but did kind of fold back into that zone a little bit today. But generally speaking, it's holding up pretty well. Japan is holding up pretty well. I'm liking the bounce action out of the United Kingdom right there, and even Germany looks decent. So while these charts aren't lighting the world on fire necessarily, they don't look terrible either. I would say they're more bullish than bearish, and that is a helpful thing if you want to be, positive on this current market, like many of you are. Let's go ahead and now take a look at our U.S. sectors 12 grid, which will be chart 4G. And here we only have two pink charts on the board. That is energy. We did have a little bit stronger pullback in the energy stocks today. So remember, crude oil itself was up, but energy stocks don't always have to follow what crude oil itself does. So energy stocks did take it across the chin here today. Looks like it was one of the worst performing sectors, probably after the staples. The staples were down 0.82% today. And again, that was largely a Walgreens story there, whereas energy probably a little bit more broad-based of a pullback within the components in the energy patch, but it was down 0.69% today. Having said that, I don't think that chart looks terrible. It's good to see it above a rising moving average, but maybe just a little bit of hesitation there due to the bearish posture according to the market forecast. Remember, you can have a different posture yourself. You don't have to follow what the market forecast technical indicator suggests. There's hundreds of technical indicators out there, but it's just one more tool for the toolbox. And then you also have utilities struggling a little bit here over the last week, and I would have to say that's probably a result of what's been going on with interest rates. Remember, interest rates have bounced in the last week, and so utilities have maybe struggled as a result. Otherwise, these charts do look pretty darn strong. You can see that the S&P 500 has that bullish posture. Communications is bouncing up there near 3-month highs. technology is now up 21% in the last 3 months. That is a stellar move out of entire category of stocks, and not even a small category. Remember, technology from a market cap perspective is the largest sector out there, and so, or at least once upon a time it was. I should take that back now that they've kind of chopped it up with Google and Facebook heading into the communication space. It might not be currently true, but nonetheless, technology still has Apple and Microsoft and Oracle and these other big companies in it. And so it's a huge sector. And to see that huge sector up 21% in just 3 months' time is quite impressive. In fact, we're going to be talking about that here in just a second when we get into our trade application example, because it does come from that technology sector. But otherwise, you can also see discretionary doing quite well. We talked about Lululemon last week and the strength in some of those retail names. We also see that the staples look pretty decent if it wasn't for today's pullback with Walgreens, but that was actually a pretty good looking chart up until the last couple of days there. And then even real estate is hanging in there like a champ. So we've got some decent looking charts there from a sector perspective. Even I'll also point out that materials on an intraday basis hit a new 3-month high here today. So again, notate that technology is the leading sector at this current juncture on a 3-month basis. In second place would be real estate right there. That's just behind it at up about 20%. But with technology up 21%, I thought maybe we could go out there and start hunting down various technology-oriented companies that might be kind of in an upswing. And so I did find one that is a very well-known quantity, at least for many of you it will be. Let's go over here to chart 4A to pull this up. And it is Cisco. Not talking about the food Cisco, we're talking about the tech Cisco here. So this is the networking giant that has been around for a very long time. Remember, Cisco once got knocked to the ground during the dot-com bubble like so many other tech companies, but it ultimately became a survivor and then went on to domination. And so a lot of comparisons here recently with these unicorns coming out in IPOs in 2019. And, you know, some people say it reminds them of, 1999, et cetera, et cetera. Well, if you can prove to be a survivor in your IPO class, there could be still good things on the horizon for you. And Cisco has certainly been one of those amazing stocks in recent years. And so you can see right here that Cisco is doing quite well on a 3-month basis. It is in a significant uptrend, and what I like about it is that it's been consistent. So not only has it felt like there's been pressure, true pressure to the upside on Cisco, but when it does fall, because remember, not every stock is going to go up every single day. That's just asking too much out of a stock. In fact, it's not even healthy, so you shouldn't want that. Stocks will pull back along the way. What we're looking for are stocks that don't pull back with too much fury. We don't want a stock that goes down dramatically only to snap back really quickly, right? Those are the types of trades that you have a hard time hanging on to. So this is kind of a quiet mega cap technology trade as opposed to maybe some of those other stocks. I know we took a trade on Twilio in this presentation a few weeks back. Twilio is a new up-and-coming growth type of a company. Doesn't really make a whole lot in the way of earnings. Cisco is way past that phase. Cisco is much more of a mature company. In fact, they've done a good job of raising dividends over the years as well. Cisco has been one of those unique companies that's been kind of a crossover stock in my various classes that I teach for my premium students, where we've actually bought it in my dividend classes in the past, and we've also bought it in my trend trading classes. And so it kind of has a more appealing element to a lot of different groups that are out there. But as you can see, we hit new multi-month highs. In fact, this might be all-time highs here today. Let me just double check. Let's go to a year first. Clearly, this is a 1-year high. Let's go to a 10-year chart. Clearly, this is a 10-year high. And let's go to an all-time chart. And this one, we're not quite there. So you can see that during the height of the dot-com bubble, it got to as high as 82. So where does it stand right now? Well, it probably takes us back to about this candle right here in October of 2000. So basically, anything from November 2000 to where we're at right now. So let's call it about a 19-year high. In other words, it's had nice consistent pressure there to the upside. Now back to the 3-month chart. What I thought we would do on this is handle it like a trend trade. In other words, we don't have an upside price target. Our goal is to let our winners run and keep our losses reasonably small. And so we're going to allow this thing to keep on going up in the hopes that it continues to do exactly what it's done over the last 3 months, which is produce more and more higher highs and higher lows. Now, if that doesn't occur, and remember, not all stocks will keep on going up, so we have to kind of manage our risk accordingly, we will put a stop loss below our trade to ensure that if it does start converting from a stock with higher highs and higher lows to a stock with lower highs and lower lows, that we don't have to suffer too much of a bad result there. So what I think we'll do in this case is simply buy 100 shares in paper money and apply a $5 trailing stop to it. Notice that the stock closed today at $55.29. So if we applied a $5 trail stop to it, it means that if it turned around immediately starting tomorrow, our stop loss would be down here at about $50.29, which does put it lower than this bounce that it had here on March 8th. It also puts it lower, of course, than this bounce that it had here on March 25th. So in other words, at that point, we would have to confess that yes, the trade is done. It's no longer in a series of higher highs or higher lows. So in order to implement that particular trade, it's pretty simple. We'll just click on the chart. And this is a right click, by the way, right click on the chart, and go to Buy Custom with Stop. Right there in the middle. That loads up our trade down below. Now you're going to want a position size according to whatever your paper money account suggests. For us, we're just going to do this for application example, and so we're just going to leave it with the generic default 100 shares. But we will go ahead and change this top line in the green here from a limit order to a market order, so that way we get filled first thing in the morning. Obviously, if you want to use a limit order, by all means do that, but we're just going to try to get filled on this one. On the bottom line right here, or on the second line, I should say, where it says stop, I'm going to click on that and I'm going to change it to trail stop here. And then to the right of trail stop where it says day, I'm going to change that to good till cancel. And then finally on that bottom line right there, we're going to change that from minus 10 cents to minus $5. Change that right there. There we go. And so after I click out of there, I should be able to click confirm and send and just review this one last time. It's basically saying, yeah, we're buying 100 shares of Cisco, and we're going to put a trail stop in there that will trail it by $5. And otherwise, the stock will continue to make profits for us. But if it does fall, we'll get knocked out with, potentially a $500 loss at the worst case scenario. Otherwise, it could actually be much better than that if the stock does go up for at least a little bit of time along the way. So with that, let's go ahead and click on send, and we'll see if we can get filled on that first thing in the morning. All right, thanks for joining me here today. It's always a pleasure to go to work for you. David will be back in the seat with you here tomorrow. But right now, things are going pretty well. We do have bullish postures across the board. We do have that bullish intermediate confirmation signal on the Dow Jones right now as well. So with that, have a great rest of the night. Best of success with your trades and your investments. And make sure you click like and retweet if you get value out of these videos. Take care, everybody. Bye-bye.